Hello everyone, I welcome you all once again to my education channel Prabhavi Education Hub, and in this video we will be learning about QFI scheme. This is qualified foreign investors scheme. Okay, so this is chapter 14.9. so make sure that you have also watched my previous videos because they are very important, and do subscribe to the channel and do not forget to press the bell icon. So as usual we will learn point wise. The number one point, the QFI scheme was first permitted in budget 2011-12. When the budget was produced, government permitted along with the budget QFI scheme. QFI stands for qualified foreign investors. They can be individual, and individual can also can also be a QFI, or some groups. So the group also can be QFI. Okay, so these people are now, after the budget 2011-12, permitted to invest into the Indian mutual fund directly, following their meeting the criteria of KYC norm. KYC stands for know your customer norms. Next point, in January 2012 the scheme was expanded to invest in Indian equity markets also. So in budget 2011-12, here you can see they were allowed to invest in Indian mutual funds only, but in January 2012 the scheme was expanded. Basically the QFIs were expanded to invest in the Indian equity market. Next, in budget 2012-13, one more development was there. Basically they were permitted to invest in corporate debt securities also. Okay, corporate debt securities and mutual fund debt schemes, subject to the total overall ceiling of $1 billion, which I told you in the previous video. Basically they have a max limit beyond which they are not allowed to invest into corporate debt securities and mutual fund debt schemes altogether. They cannot invest more than $1 billion. Next, later QFIs were also allowed to open individual non-interest bearing rupee bank account with the authorized dealers bank, because they are now investing into different segments of our market, such as Indian mutual funds, such as also corporate debt securities, equity market. So their transactions they need into the rupee, so that is why they are also allowed to open individual non-interest. So the deposit account will not be having any interest upon that. Whatever the amount deposited into that account will not be given, there will not be given any interest by bank to them. So they can now open individual non-interest bearing rupee bank account with the authorized dealer bank, who authorized RBI. Okay, next point. Next, in June 2012, one more development was there. The definition of QFI was expanded to include residents of the member countries of Gulf Cooperation Council and European Commission also, because they are part of FATF. FATF is Financial Action Task Force. Okay, so basically they permit countries to take loan. They are just like, they also give rating accordingly. They also ban some countries from participating into the world market. So FATF is a Financial Action Task Force, and these countries such as Gulf Cooperation Council, the member of Gulf Cooperation Council, and European Commission, the member of these units, member countries, are basically part of FATF. So that is why they are also allowed to participate into the Indian economy through QFI scheme. Okay, next point. Now, why actually Indian government is trying to expand the financial investment, trying to basically escalate the investment process? Why they want more money? There are two broader perspective. For example, First one is India's rising current account deficit. So India has a very big current account deficit, which crossed an all-time high 6.7% by March 2013. What is current account deficit? Suppose India is basically trading into the world. So suppose its import and export mismatches. Suppose import and export. Suppose India has more import than export, then the foreign exchange burden will be there on the India, because India has to pay for import in the dollar term, in the foreign exchange. Okay, because import is paid only in foreign exchange, and for export they will be getting foreign exchanges, but the mismatch, the import and export mismatch, what happens if India do more import than export? Definitely there will be high current account deficit, and this deficit is called current account deficit, and that was all-time high 6.7% by March 2013, which is creating heavy drain of foreign exchange. Okay, so basically there was heavy drain of foreign exchange, and India need to maintain its foreign exchange because of many obligations such as loans. Also India has taken loan from different organizations such as World Bank, etc. So India need foreign currency, and this foreign investment will be in the form of foreign currency only. So India will be having more foreign currency, foreign exchange. Next, the objective of attracting more FIs, foreign investors, while the Western economies are under the spell of recession. So the Western economies were under the presently they are under the recession phase. So why not to use this opportunity for cashing out in the form of opportunity? So India is basically trying to use this opportunity as a cashing in basically. So that's all from this video, QFI scheme. I hope you like the video. If you like the video, then please give thumbs up to it, and also subscribe to the channel, and do not forget to press the bell icon, and we will meet together with a new video on this topic. 14.10 I will be coming with. So wait for that video, and bye.